The big bubble is fiat and debt. Debt is the problem. We are in a debt-fiat debasement era. The proliferators have got to the end game. A whole wave of algos suddenly rushed out to say, at the localized high of gold, to say how there's going to be a sectorial rotation into Bitcoin. And in actual fact, the exact opposite has happened. We're only in the first innings of this precious metals bull. I can't think of anything else that could make this a more bullish environment for mining and monetary metal. With what gold is doing, it is the true canary, and you should never take your eye off the canary in the gold mine.
Francis Hunt, financial analyst and founder of the Market Sniper. It is a true pleasure to host you on Palisades Gold Radio today.
Delighted to be with you. Thanks for having us on.
Francis, really excited for this chat to get a feel for where financial markets and precious metals might be going. And that's actually exactly where I would love to get started, precious metals. We're in the midst of an incredible bull run. Gold specifically is up over 60% year to date. Phenomenal returns. However, we have seen a bit of an increase in volatility recently. Is the long-term big picture thesis for gold still intact?
Short answer, Stijn, absolutely. It's 100% intact. In fact, nothing goes up in a straight line. We'd gone very strongly up in a sustained basis for quite some while. But we are looking quite positive for potentially winding up to make further renewed highs. So for those that might, so I suppose the question is that the top? Many people ask, and the answer is nowhere near. And there's no way that the precious metals bull market, I'll tell you what are my criteria for start thinking that a top might be in, and maybe that will help answer the question more fully. First of all, we had a gold-silver ratio in the 80s. That I personally suspect that we'll get a single digit by the time we're done, not just 30, a breakdown to 50 or 65. I think in terms of the scarcity of above ground supplies of silver, we'll see us do a single digit. That means 9.99 or less. We're a very long way from that. So it's not even happening. The miners have not begun their outperformance to metals. We're a long, long way from that. So every aspect of major bull markets, this is the initial metal, and it's the king who is aging a bit. He gets up from his chair slowly, but everybody else waits for him before they stand up after the meal. And the king moves first, and that's been gold, and gold is at new highs. Silver's only recently made a marginally higher high at the 54.5. So it's early doors for the prince of metals, and he will outrun his father. He has youth on his side. So it's all ahead of us as far as I'm concerned. And the precious metals miners, which are actually experiencing a recession on their costs through the oil price, which is something we called for over a year ago with our long gold short oil trade. I'd like to remind people, sounds slightly, we get a few right every now and then. It very much sees their bottom line in a recession and their top line facing a potential parabola, high lease rates, shortage of above ground silver, particularly if you're talking silver miners, and we're especially bullish platinum as well on top of that. So there's quite a bit to unpack in that answer, but we're only in the first innings of this precious metals bull.
Quite a bit to unpack there, definitely. And we were having an incredibly interesting chat before we started recording, Francis, where you were tying so many things together. And I think that's what's really interesting about your framework, about looking at the world, where you look at technicals, fundamentals, geopolitics, and you try to all condense it into one thesis. We were talking about AI and how much of that is part of the economic growth that we've been seeing recently, and what the impact of that could be for precious metals.
It's going to be, I think it's going to be part of jettison, what I'd say almost the coiling up of a spring that's going to give the next leg up. It appears to me that we're seeing the fraying edges of a potential AI contagion issue. I'd like to also highlight that David Sachs, who seems to be some form of a czar of AI in America, has recently tweeted out, in contrary to previous messages, that for him, AI investment has represented 50% of the growth of the American economy. And that were it to run into trouble, they would go into recession. So it's almost the case of if you don't support us, we're going to drag you down. That's kind of the message. I have to say the support that you've got on the upside has not been for the average American. It's been very much a select group of corporate fascist corporations which are hell-bent on building the surveillance grid, because I think the primary usage initially of AI and robotics will be compliance of citizen, both on tax extraction, freedoms of movements, and a variety of other things, as well as involving digital IDs and biometrics. So the whole thing that this is for our greater good and that we should love it and care to bail it out is entirely questionable. I would actually say the inverse is true. But it's almost being positioned as a banking system, as such a critical key industry, as such a thing as the issuance of money and the ability to borrow and lend. And you're going to get the equivalent of subprime, only now we're going to allow the insiders and these corporations to once again privatize profits in that space, make malinvestments, hyper chase up costs for chips to create a stock frenzy. And then on the downside, on the detoxification of this imprudent investment, as well as signs of clear fraud. And I refer you to some of Michael Burry's revelations on and around that, from amortization, depreciation, buying things on contract on the basis of conditions that have yet to be met, all forms of very Enron, WorldCom type vibes, that we could be once again on the hook for refinancing, shoring up balance sheets in a post-AI collapse. And this, of course, typically by nature leads to proliferation and debasement, which is incredibly destructive for the man in the street, because it's further inflationary forces on cost of living, which of course is not bad for those that have invested in gold, silver and platinum, by the way, but very bad for the average layman. And of course, bailouts and the accumulation and government taking ownership at the bottom after all the leverage Robin Hood fans that have been chasing Nvidia and some of these other businesses associated to AI up to the moon on the way up. So I find that's of deep concern, but it does set up the opportunity for precious metals on another leg to the upside post any remedial government intervention on such an event.
Yeah, because what you're really alluding to here is a potential significant financial hiccup that we might see due to all this AI hype, and therefore you might see government intervention because it's too big to fail, supposedly.
Correct. And the fact that it's for our greater good that it gets bailed out as well, when in actual fact I dispute that entirely. Debt is the problem. We are in a Debt-Fiat Debasement Era since the 2020 turn in the bonds market, which we were one of the first to point out. And that makes this the gold epoch. And again, it's a debt-related system and point of failure. The CDSs on Oracle are one of the key sensitivity indicators of where we're at, having borrowed recklessly, and the lack of willingness for new people to be backing the soundness of that debt that Oracle has entered into, which has also been replicated in other ways and means by the likes of Meta, formerly known as Facebook, that have created, gone into SPACs such as Blue Owl, which end up being the bag holder for debt and depreciating assets. Chips depreciate rapidly. And Burry has pointed out that the changing in depreciation finance has boosted earnings. So there's a whole lot going on. And I've got some of the facts to my hands, but there'll probably be, Michael Burry would probably be the most interesting person to speak to on that. And I find he's rarely wrong. He's often early. Some people will say that's the same. I would argue not quite. And we are positioning to benefit out of the contagion collapse of the AI space that I think they are setting up, which will ensure greater ownership of state and a further proliferation. And I point out that the CV19 events, where we were first time we said go long gold, short oil, in 2019, also got around the September-October period a repo market liquidity problem, which invariably is about the intrabank plumbing. And we've recently had similar. We've covered the Cayman Island hedge funds and all the repo exploitation to see Cayman Islands be a holder of 1.8 trillion of America's debt, which, by the way, they have a GDP of about 7 billion. So it's a bit like you being, Stijn, on 250 grand a year, but having a 68 million bond portfolio. I think you would consider that disproportionate wealth and investment, but somehow the Cayman Islands has got there. So there's so many aspects that are at the point of failure, and repo markets, the key point I make is repo markets are often a real canary in the mine for banking and debt stress. There's also the private credit. There's so much more that can be said, but just to fly past all of those to say things are wobbly right now in my terms, and only the bond markets and debt markets tend to highlight these things first in very specific areas, and stock markets are the last to realize it.
Today's episode of Palisades Gold Radio is proudly brought to you by our parent company, Palisades Goldcorp, Canada's leading junior resource investment vehicle, trading on the Toronto Venture Exchange under ticker symbol PALI, with equity and warrant positions in over 200 companies, ownership of mineral projects and royalties, and a significant stake in newfound gold. Palisades offers investors powerful leveraged exposure to precious metals, uranium, copper, and other critical minerals. Palisades shareholders directly benefit from our team's extensive industry knowledge and access to deal flow, opportunities historically reserved for a small group of investors. To learn more, visit us at palisades.ca and join us in our mission to level the playing field for investors. Now, back to the show. And I guess this almost inevitable bailout that you're describing here would tie into that accelerated debasement thesis that you have, right?
100%, because it just leads to further proliferation. The other flex or pivot they might pull is that they may actually utilize stablecoins to proliferate in this event. It's the same thing. It just would be the digital dollar, and that would further progress the on-ramping of digital dollar and, you know, the surveillance aspect of how it is spent, how it is utilized, blockchain, etc., and everyone getting a wallet. So there can be, you know, incremental developments that take us further into the digital monetizing space. Stable coins currently are purchasers of treasuries as well, so it does create a bid for treasuries in an environment where we are facing a parabola of issuance. So the temptation there must be a detail that I'm sure they'll potentially consider as well as a flex in any forthcoming bailout. But I think this is where you should be looking.
And Francis, do you think this gold bull market that we've seen has almost been a controlled rise in gold? I recently had a chat with Matt Smith, who outlined this thesis that he has that gold is currently the liquidity sink that the government is using to you know, flow excess liquidity, excess money supply growth into, kind of like how they used oil in the 1970s, 1980s. Do you think this is why we have seen that rise in gold that we have?
I think it is. And I think it's also put the lie to Bitcoin being that recently. A whole wave of algos suddenly rushed out to say at the localized high of gold to say how there's going to be a sectorial rotation into Bitcoin. And in actual fact, the exact opposite has happened. The last 3 or 4 months have actually been generally very poor for Bitcoin. Silver's a very low percent from its all-time high, gold not much more so, whilst Bitcoin actually probably languishes, I wouldn't even want to put a number on it, but they were as high as 126 and they're in the mid-80s now. So that's quite a substantial percentage down. And many people postulated that Bitcoin was the excess liquidity sponge. And what we're actually seeing is that we are in the epoch of preservation of capital, and central bankers often end up with that excess liquidity or big institutions. And what they are choosing to buy is clearly not Bitcoin at the moment. I'd further add that a lot of OG wallets that have actually held Bitcoin since 2010, 2013, in that era, have actually unloaded billions in Bitcoin, and that there's a real sectoral rotation out from people that were very well positioned very early in what I suspect is an on-ramp for the digital environment and was part of an interim phase of transitioning us to this digital system that they have envisioned. So I'm giving, I suppose, Bitcoin maxis a bit of a kick between the legs at the same time as jumping onto your point that the liquidity is flowing towards the ultimate store of value, which if physically held doesn't come with any surveillance, doesn't come with any trackability, and is pure money and real proof of work, which involves digging holes in grounds, not solving difficult sums in the ether.
Francis, when you look at the incentives of the US government with their balance sheet that they have, the liabilities, the outflows that they have, it almost seems that they're incentivized to revalue or even remonetize the gold holdings that they have. Do you think that is in the cards for us in the immediate future?
I think people are being continually tempted with this, and it's often the carrot for the donkey. It's been put in front to keep you in hope and walking. I don't rely on that to deliver my alpha. Just the ownership process will bring it. I'll also point out that if America is actually in a Cold War, an economic, financial, software, AI race, etc., against the BRICS nations, particularly China, maybe Russia, and the others, it doesn't actually benefit them to upvalue gold if it's going to make their enemies even richer. I would also say I'm deeply skeptic about the true holdings of America. I don't take anything that comes out of the American system as being particularly more honest than what comes out of the Chinese system, as they always like to portray. Western media has a habit to say, it's a communist nation, they only lie, we tell you the truth. And I'm sure the Chinese propaganda system is saying the same. Anything that comes from government in these extreme fiat debasement times is people management news. It should not be taken factually. We don't have a true CPI. We called out the labor stats were a lie for the last 3 years, and then you got all the revisions, monthly revisions, quarterly revisions, annually revisions. It's proof that the original recession that was a recession actually was a recession. You weren't bailed out by employment numbers. Everything has to come back to truth, including the events of CV19 and the damage that did. So in the end, government's first port of call is to deceive. And to keep you misinformed, and that's how they should be treated, as an active attack vector against your financial, your freedom, and your economic liberty. And that's how I continue to treat them. So when it comes back to these elements, I have no trust in government. And in fact, what we're seeing is the rest of the world starting to have a zero trust process towards the dollar-based hegemony. And China is positioning, remember that's a communist nation, and America and Europe are supposed to be capitalists. They aren't. It's a cacocracy of insiders that we haven't had true capitalism in ages. China is actually saying we want to win this game, we need to have a higher trust element, and they're talking of gold vaulting across all nations that they trade with actively on a regular basis, and real disclosure. So you should always play the principle. And for me, sadly, the principle is actually with the communist nations that will have vaulted money in the form of gold as a trade balance, and it will win my confidence over the tail end of an overly proliferated fiat debt system that is clearly in propaganda mode.
Francis, I believe you started alluding there at that BRICS currency that they're talking about, potential 40% backed by gold, 60% backed by local currencies that might be used to settle international trade through the Shanghai Corporation vault. Would that be a type of soft remonetization, and could it force the West to take a different look at gold again?
I think the minute you start introducing some element of gold backing, it's going to win the trust over those that don't, and it will force the hand for similar reaction. If America is able actually to do that, and if what we've been told in Fort Knox actually exists, which I actually doubt. But anyway, regardless if I turn out correct on that suspicion or not, the gold percentage will increase. I will highlight, though, we can't marry any one government. We don't swing from being in love with the US and the Western world to suddenly being in love with China and the BRICS and the Grand South either. We should play the principle. And if there's gold backing, it's more sound. But they will go for the lowest level of gold backing they feel they can get away with, that will allow, they think, in terms of the mass of people, that faith will be reestablished, but the restriction of having gold, because you've got to remember, gold is a discipline when you are a central bank, and all governments want actually to have the right to proliferate and inflict inflation as policy on you. So they will eventually, over time, look to walk away from any new commitments. So they want to promise you a new deal, a better deal, that they can start whittling away in some point in the future. So this is my active cynicism against all forms of government. Central banks' primary policy is inflation and will always be, even new ones that want to tell you they love you more than the other and be my girlfriend, boyfriend. They're to be distrusted. They will go down the same route in due course. However, what they may introduce at inception may come in at a far higher level of trust, and therefore you will have to utilize, as someone who has to participate in the system, the better version thereof. Don't have romantic notions about the fact that the long run of all central banking is to put you, to throw monkey money at you, and over the time to reduce the trust or to reduce the sound money aspect to any new solution.
Well understood, Francis. Thank you for outlining that. And taking you back to this accelerated debasement thesis for a second, are there any historical parallels that we might draw upon to predict where this bull market for precious metals could go towards?
I don't think there is any market that is parallel to this one. And the reason why I say that is scale, number one. So the scale of the proliferation has truly been unhinged and vast. Every last corner of indebtedness and financial engineering has been applied. In America, you can literally have 7-10-year mortgages on cars with only 40 or 50% of the purchase price being paid, and the remaining, the residual value of the car at the end of that duration needing to be part of the remaining payment, where in fact they are depreciating far faster, and shortfalls are being rolled up and put into another shotgun finance deal. I mean, the absurdity of the excessive financial engineering is on another scale, and it's been globally synchronized across multiple Western nations. So this is not just an American hegemony crisis that will fall. Yes, the hegemon falls hardest in the end, but it is also the West that has been to a degree synchronized in a similar manner. You look at the governmental policies being pursued by Europe, the fact that Germany is facing twice the energy costs of the rest of Europe because of the political positioning against Russia with regards to the Russia-Ukraine conflict. These are all policies of unsound money that escalate costs and destroy big businesses that are huge employers. So we are part of a total controlled demolition that is actively being perpetuated, not through incompetence but by design, that will lead to impoverishment of the citizenry in all of these Western nations, and see you thereby be a recipient of UBI and serfdom and at the behest of a draconian totalitarian government. So this is not just about financial aspects. It is about freedom. It is about liberty. It's about far more core aspects. And I fear for most people that are watching this in the West, they don't truly recognize that it's not the place to be to see this out.
Incredibly interesting outline there, Francis. And I presume, of course, someone that holds precious metals in a scenario that you're outlining here, they might not just maintain their purchasing power and through that their freedom, but they might have an opportunity to actually gain in wealth as well as the rarity of those commodities increases.
Yes, it's a fascinating. The word for crisis in China actually is two symbols. And inside of those two symbols are a number of things. It is the crisis, which is the downside, and then there is the opportunity that crisis brings. And we are in an environment where both will happen. Now, the key thing is you can recognize the problem and be in fear, deer in headlight and get smashed by the Ford F-350 coming at you at 60 kilometers an hour, or you can see the opportunity that the truck is coming and make sure you're jumping on the back of it. I will point out there's three mechanisms that we can absolutely come out of this far stronger. And this is what our community focuses on, building wealth in reset times. First of all, there's three processes, and then there's a fourth step you take. The three processes are: get out of the stock market. Generally, many people, particularly Americans, are overexposed to the stock market. By getting out of the stock market, you get into cash and liquidity. That cash and liquidity gets rotated into precious metals, which is preservation of capital in these times. Many of the people watching this have already done steps 1 and 2, maybe not overexposed to Nvidia, maybe having quite a bit of gold and silver on hand. But then we get into the more interesting aspects. Point number 3 is the volatility, the contagion, and the crash. Recognize where the highest bubble is, and this is debt, and also debt in relation to AI. So we have puts on Palantir, MicroStrategy, various other players that have been hyper leveraged. And in fact, Burry is very similarly positioned. And we expect to profit out of the collapse that those opportunities create. Just as the too big to fail money starts to flow in from government, we'll be getting out there. I would expect miners potentially to have a sell-off, not because they deserve to, but because so many people will be under so much financial duress in the disinflationary spell that will come, that there will be forced sellers, and that will create a buying opportunity. Profits from puts will be put into miners, which I think will be the outlier beta, because for what I've already described, cost-based recession, oil down, and top line parabola, precious metals up, till eventually their outperformance will be rewarded to gold, silver, and platinum, and they will be unbelievable movers, and that will be part and parcel of the recovery that then follows any potential disinflationary, demand-destroying event that comes out of this.
Francis, earlier on this chat, you outlined that silver is currently trading in relationship to gold at a ratio of 80, and then you think that gold to silver ratio could compress all the way to the single digits. Why do you think so?
It's a good question, and typically markets overshoot. And when you look at mining scarcity, you tend to revert back to mean. Now, some people will say, well, we haven't been at 8 gold-silver ratio for multiple decades. And I would argue that the financialization of the world is not been the last 5 years or the last 10 years or back to subprime. It's not been back to .com. It started from the last bull market in precious metals in 1980, following Volcker pushing up the rates. And since then, you've had a manipulated environment where silver has been bullied by the financial mechanisms of derivatives for an extended period. Stockpiles have now been run down, and above ground supplies are at critical levels. So they've actually run this game as far as they can fundamentally in terms of available silver, given the blowing increase in demand and use cases for silver versus that which is being found. It also has to be pointed out that the large part of silver supply is not actually from silver-specific mines. It's been so uneconomic that there hasn't been a lot of silver-specific mines going out there for the price that is going on. So exploration has been exceedingly low, and supply has come from recapture of previous use, computers, etc., and copper, zinc, and gold mining. And you can't forecast for, hey, will we find that secondary product when we back down there? Don't forget the cost of finding silver when it's a secondary product in a mine is being carried by the primary metal. So it's just a bonus over on. Yes, it might become important for their margins and they'll factor it in to a degree, but the mine isn't there because of the viability at current prices for the silver. It's there for the copper, the zinc, and the gold. So when you look at true plays of silver, there's far less. And you just don't switch them on. You don't turn that demand on like that. It will take decades, especially since the green agenda has made in the Western world it's so difficult, in fact, which is one of the reasons why I think the current administration is going to continue to throttle oil and continue to try rein back the green agenda as they go into a commodity pursuing type way. You know, Trump came out with the stage drill, drill, drill when it came to oil. And I think it's dig, dig, dig in terms of miners as well. And he was talking about Greenland and Canada and annexation and all sorts of bizarre things. This suddenly shows that the people behind him are recognizing, who are pulling his strings, that actually this is a commodity cycle and we need to be focused on that. And all sorts of deals are being done in a bid to actually secure things that are in the ground. But unfortunately for him and his handlers, you just don't switch on silver mines and massive amounts of silver supply in any great hurry. And neither that for platinum, which is even thinner and smaller market in both. So we're in a very early stage, very strong environment where there can't be anything, I can't think of anything else that could make this a more bullish environment for mining and monetary metal as commodities, and not to be confused with energies such as oil, you know, as we've suggested regarding our gold long, oil short. They need the CPI to try stay as low as possible, and the consumer is highly wrecked, which has been a very, very overhanging element to the aspect of oil. And I just highlight that because a lot of people on X have been, since gold had the localized high, been trying to convince people to be buying oil shares. And as I've said, we called for this over a year ago, and it was a repeat of a call we made in 2019. And you've had so many looky-likey aspects like the repo plumbing of September and October going. Short oil, long gold. It's monetary metals, bull market, and it's an energy crush consumer bear market with a needed downward pressure on CPI because they want lower rates, they've got debt to roll, and so many other reasons. And that's where we were, as I say, that's our YouTube that we put out on that very point over a year ago. And more recently, literally today, yesterday, and the day before, Goldman Sachs were coming out and saying $40 for oil. JP Morgan were coming out and saying 30. And someone just told me this morning that Jim Ricard's ex-CIA advisor, interesting profile, was suggesting $20 oil. So now everybody's coming to our camp when we were standing alone and saying you need to stay short oil, long gold. And that gives you an incredibly volatility dampening effect to your positioning. Because if the dollar has a surge, and it's just had a long collapsing period from 110 on the Dixie to 96, it's actually got some relative strength to some other fiats for now. What you get taken off your gold, you're more than making back on your oil. And when we called that, oil was $87 and gold was significantly lower. It was below 2,000. Now you're at 4,300s. I think, what are we now? 4,100s now. And you're at $59 and $58 oil. So, and you had lesser risk-adjusted volatility in your position, where you hedged out your dollar strength exposure.
Incredibly insightful, Francis. So many threads to pull there, and I'll have to park some of them. I would love to continue talking about oil and gas for a second. And when you look at the producers, when is cheap enough? If you look at the fundamentals from a demand perspective, completely understand your thesis. Of course, it's also the supply side. And we hear people like Rick Rule, for example, state that on that side, underinvestment has been the theme for oil and gas producers, not investing enough in sustaining capex, exploration, and the likes. When are the oil and gas producers cheap enough to take up a position?
My overall view is that people are over-focusing on energies generally. The best game in town and the overweighting is right here where we stand in precious metals. You've got to bear the following in mind. America's shrinking its sphere of influence to the Americas, and you have ships parked outside Venezuela, and they might just be ready to start some hot war, either on Venezuela, maybe that'll extend to Colombia. I don't know what they have planned, but Venezuela has more reserves in the ground than the Middle East. People should get over peak oil or shortage of supply. Your demand is your problem. Your demand is based on consumer. Some people say, oh, but data centers are taking a lot of energy. You'll get hit on a localized distribution level as an American in your local suburb where a data center has been done. That's part of them socializing the cost and privatizing the profits on you. They're very good at that, but that doesn't mean you have a shortage of energy. That's a grid capacity and an infrastructural related issue. And of course, a criminality, as far as I'm concerned, a cross-subsidization issue, which just shouldn't be applied. But in terms of actual supply, I don't feel there's any shortage, and the demand is very negative. The consumer is wrecked. As I've said, there was a true recession that was never acknowledged. My personal assessment is you've been bouncing in and out of recession. And if you don't have a true inflation rate, you wouldn't know in real terms how much you've really grown because you're sitting on a bad number, which isn't being fully expressed. Debasement of fiat is your, and debt is your inflation. And that is being reflected in the gold price. And you're in a parabola of movement. If you look on any decent time frame, that's where you are in gold ounces. So your fiat debasement is huge. Your cost of living is high and is being understated. Shadow stats in the US give you a far more accurate on the 1980s Ronald Reagan number without having adjusted the basket numerous times, meaning it's comparable year to year, decade to decade. Of course, you get lies, damn lies, and statistics. And if people get to fiddle the basket as they choose, they get to move in anything that's disinflationary and reduce the impact of anything that is reflecting inflation. So we're in a propaganda-based world in terms of statistics. Anything that comes from the BLS should be treated as BS, and you should be very, very focused on anecdotes. And, you know, we had a lady who had a checkout till from Walmart from the bottom of 2020, and that in 5 years was paying 2.5 times for the exact same item. She literally did a checkout online till 2.5 times, 2.25, it wasn't quite 2.5 times for the exact same checkout of like-sized items, item for item. That's in 5 years. That represents over 100% increase to the upside in a 5-year period. And that's far more in line with what gold is doing. It is the true canary, and you should never take your eye off the canary in the gold mine. Gold, gold, gold. I would not fascinate on stocks. Eventually, we will get to such an element where everything is inflationary and all commodities run. I would be watching softs before I would watch energies because of a crushed consumer. We've seen coffee run. If you want to watch other markets, we've seen, and we've had setups in those. But the highest percentage mover, and I bring you back to the main theme, stay in the main event. That's where you're going to do best. People all want to be colorful and broad and everything. Unless you've got a couple of platinum miners, silver miners, gold miners, you're holding platinum, silver, and gold. And it's at least 20%. Personally, I'm far more overweight than that of your net worth. You've got work to do in the best space, in the best room in the house. Stop worrying about the fact that you haven't put a suitcase down in every bedroom. You only need one good bed to sleep in, and you've got the best room in the house with the best mattress. Stay there, make out like a bandit, be overweight. The energies will be the last of the commodity complex to move, and we will be in a very more, instead of hyper-stagflationary environment, we'll be moving more to the high inflationary environment. And in that point, yes, it will move. The stock market's moved, the Nasdaq's moved. In gold ounces, they are re-rating downwards. So if you are utilizing the new basis of account in a fiat world where debasement is too much to really consider it anything more than a monkey on a greased pole, throw their monkey money back to them, get back to real wealth measurements, gold ounces, and stay in the best room in the house. That's my message.
Stay in the main event. Well understood. And perhaps you could outline, Francis, why platinum would belong to that main event. A lot of people attribute it more as an industrial metal.
One of the reasons why it just gets categorized as an industrial metal, and people here in the comments will write below, gold and silver monetary metals, platinum isn't. One of the reasons for now platinum is not, is it's only a recently discovered metal relative to gold and silver. It never had an opportunity of kings and medieval eras to treat it as it. You didn't find it lying around. It's incredibly rare. The total production that I tend to get out of various sources for platinum in any given year by mine is around 170 tons in a year. In an entire year, 170 tons. To give you a comparison, gold, you're getting 3,300 tons. So it's 19 times less found than gold. Silver is found 8 times more than gold. You listen to Keith Newmeyer and other miners. Now that might vary, it might be 7, in some places it might be 10. But the aggregate accepted level on mining, the degree of commonality and scarcity, if we're talking about a scarcity number here. So if you multiply 19.1, which is the scarcity, 19.1 ounces of gold just to find 1 ounce of platinum, you then multiply that by 8, you end up at some pretty high number. Let me get the math calculator out and I'll do it literally for you. 19.1 times by 8, and you're going to end up at around 153. So silver to platinum is 153 times more prevalent. Silver is trading at $51.4 right now. 51.4 times 153. Based off scarcity and ability to find, platinum should be $7,853 today. That's 51.4 times by 153, scarcity. Can I tell you also that the bulk of that is found in Southern Africa, Zimbabwe and South Africa, 140 of that 170 tons. And it's never been in the Western world's interest to see Southern Africa make money. It's always been in their interest to have a low cost of production. Places that produce commodities are starting to get recognized for that which they produce. Brazil will do better off softs and many other things, and countries like South Africa will actually start benefiting. And the rand has pulled back, by the way, from 20 to the dollar to below 17 and around 17, not because of good policies and great governance, but I suspect for this feature. Zelensky's billionaire, frontman for his billionaires, just bought a controlling stake in Northern Platts in South Africa, 51%. These always seem to be very well-informed people that are making these moves. So these are what I call little anecdotes that point to real attributes. A certain mining shaft has been closed that is a platinum producer on account of its non-viable. You don't find platinum that easy. The fact that it's closed means it's not, the price isn't right. That's throttling supply. It's even thinner. It has far higher lease rates, and it's virtually unobtainium to buy. It's pretty hard to buy. If you have a dealer that's sitting with inventory on platinum, please let me know, because I'm continually looking and I'm continually stacking it. And the premiums are high, and people say, oh, I can buy gold. It's not nearly as so much higher to the spot. Let me just point out, platinum right now, to me, just to the gold price, if you take its current price in and around $1,600, is probably only 35% of gold, 35 to 40% of the gold price. And that's a massive discount. I don't care if I'm paying 5 or 10% to get in. To me, it finishes significantly higher by it, and it's only for want of history that it's never been a monetized metal, because it's so recently found. And people will then say, what about its last history? It lagged immensely. We had a huge palladium substitution narrative that went with the green agenda in catalytic converters. At that point, when that started, palladium was at around $250 to $300, whilst platinum was well north of 2000s, mid-2000, 2,500. That time, it made immense sense, even though you didn't have a perfect substitute, you had a close enough substitute to cross-subsidize. The demand industrially went away for platinum. There was no bullion demand on a major scale, many a bit of jewelry demand falling away industrial demand. It got crushed. Palladium now sits just a couple of $100 behind platinum and no longer is a worthwhile substitute given what you forego by not having the actual platinum, just having an equivalence. So the entire platinum group of metals will now, in my opinion, outperform even silver. And platinum is going to be one of those that is going to play catch up for the degree that it was suppressed during this entire green agenda. So it's just for want of lack of history that people can't see it being a chronic outperformer. And in normal environments, it traded to an absolute premium to gold on account of its scarcity. So I see that all being rectified. I'm a massive silver bull, I'm a gold bull, and I'm an incredible platinum bull.
Incredibly insightful. It seems that platinum has definitely been flying under the radar this precious metals bull run. Francis, I would love to get your take on this commodity super cycle thesis that we hear relatively often, and significant underinvestment that we've been seeing in mining, causing this bull run commodity wide, with some winners, some laggards, and those might change halfway through the race. Do you subscribe to this commodity super cycle thesis?
It's one stage ahead. You've got to recognize the dominoes and the way in which they fall, in my interpretation. Of course, I can always be wrong, but everything I am seeing and hearing is validating our primary template and hypothesis of hyperstagflation. You're in an extreme version of stagflation. It's not relatable to the 70s, it's worse. It's not one country and a few Western nations, it's the whole Western hemisphere. You are seeing fiat and debt debasement, yet you are having a very weak economy. In fact, the consumer and retail and man in the street environment is very tough and is being understated. Only recently have they started to acknowledge that. You had an entire recession be denied on virtue of a strong employment market, which subsequently has been shown to be a fraud, with Democrats employing government employees. State has become too large in all economies. Government used to be 12% of the economy. They're now all in the 40 to 50% range, which means you are all in practicing socialism, the gateway to active communism, which is where they want to take you. So with all of that said, hyperstagflation is downward pressure on the consumer, the man in the street. And that is not supportive for overall inflation because demand is decreasing and it's countervailing the effects of the fiat devaluation, which should see the price increasing. So you have two forces counteracting each other now. That's the stagnation. It's inflation and also an economic repression. And that's why you're in economic repression, and they even refer to the repression, the financial repression trade. It's a terrible time for bonds and debt. In real terms, it's devaluing. These are some of your shorting opportunities, too much debt. The big bubble is fiat and debt. Let's not confuse anything. The proliferators have got to the end game. The bubble is fiat debt. That's the bubble. But they've created such economic hardship at the man in the street level that is a counter disinflationary force to the inflation. Eventually, another bailout, another proliferation, you will get a more broad inflationary environment like we had directly after CV19, and that's where everything is going up in costs. But it's going to be on a pretty poor state of the aggregate consumer, which has continued to be a wealth diminishing effect. We've gone through repressional, financial, through numerous cycles where each time the consumer is being pushed ever harder. You look at wages and the decoupling of wages. This is all about consumer repression along with financial repression. Hence why you have to position for this key epoch, and you have to be to build your wealth in an environment where incomes are actually losing ground in real terms.
Well understood. And after this thesis of hyperstagnation, you're forecasting a period of inflation, a type of inflationary boom, perhaps?
I would never classify it as a boom if we're talking about you, me, and the rest of the world. It will be incredibly high prices. Your salaries will go up, but in real terms, in gold ounces, you'll never have been poorer in gold ounces terms. The cost of living will go up, and in gold ounces, it will also have lagged, but not as much as your income has lagged, meaning that the alpha producing aspect is the position in gold, even more so silver, even more so that platinum, and in select cases, miners beyond all of them in those cases. So you have to stand on the stepping stone that raises you up. Most of the others that you'll be standing on will be sinking into the marsh, and you're going to get muddy feet, and you need to keep that head above water.
And you think in this inflationary environment that you're outlining, miners might actually be a way to potentially gain wealth?
I do, but I've made the qualification in previous comments that they're also more volatile, and going into a demand-destroying event, they can be drawn down more than the metals. The first part of everyone's portfolio should be the physical holding of the key metals, which starts actually with gold, even though of the three, I think it's going to not be the least performer. It's still going to be exceptional, but its volatility is less and brings balance to your holdings. Silver following, platinum following that. And then you're adding your miners, but you will have select opportunities if you hadn't already been in, and I still hold miners and I will continue to hold them, but I'm in a position that'll be very difficult to be a forced seller because I retain cash, I've no debt at all, I don't have relationships with banks in that way, even if they spike interest rates, and I have a cash generative business, and I have significant assets and property that's all paid for. So if you're not in that position, you could be compromised by interest rate spikes and a lot of other things. Even if you have fixed mortgages at certain rates, they could declare force majeure and do all sorts of trickery and demand instant debt. If you look at the clauses, in exceptional circumstances, banks have incredible power if you are a lending client of theirs. Or my apologies, if you borrowed from them and they've lent to you. So the point being, don't be compromised that you could be put in a situation as a forced seller to find cash. And I would actively state that the agenda of governments throughout the Western world is actually to tax scavenge and to cause wealth destructionary effects on you as a citizen so that you cannot be self-reliant and a sovereign individual. In other words, government is an attack vector upon you and will do all that it can, including unrealized capital gains taxes, exit taxes, all forms. And we've spoken of tax scavenge event. Don't forget, government's policy of inflation has always been silent taxation upon you through the active act of inflationary policies. That is covert and passive. And, oh, we'll give you this, we're going to give you a minimum wage, we'll do this. Meanwhile, you are paying for it and some across the board in debasement. Once the bond markets aren't playing the game anymore, and it's far harder to excessively spend to income because of interest rates and the bond market turn, which I refer you again back to the 2020 pivot event, they no longer can go on a bottomless overdraft basis. They turn more aggressive, totalitarian, and say, you've had the good times, now it's time to pay, towards their citizenry. We've identified this as tax scavenge mode. We've explained this concept, and we've pointed out that you should expect more aggressive conduct out of government towards its citizens. And we've done a definition of that very fact over here, and I'll show it to you right here. Tax scavenge mode occurs when governments that have been covertly taxing you through inflation and excessive debt expenditure revert to totalitarian, new direct tax initiatives and cuts to services as well, by the way, to the social contract, because borrowing has now become too expensive and untenable. So exit taxes, all forms, and you only have to look at the United Kingdom. You look at Italy talking about getting taxation on legacy families, Italians holding gold. You look at the EU talking about unrealized capital gains. Yellen was talking about unrealized capital gains. This is actually punishing you for preserving your wealth when they are debasing money. They are punishing you with a capital gain on account of which you positioned yourself to preserve your buying power against their debasement policies. This is legalized theft. They wrote the law up to steal from you. That is the only way you can view it. Again, I say, the governments of your Western nations particularly are an attack vector on your financial wealth and freedom, and they will reduce you and the quality of your life immensely, as well as freedom of movements. You need to contemplate your long-term future in any of these nations, and we address this directly. That is tax scavenge mode, and you are starting to see it actively take part now. Out of headlines, Rachel Reeves in the United Kingdom, a swathe of EU examples. There's an exit tax being mooted by the Dutch. I think you might be from there, Stijn. I don't know if you have family members, but it's across the board. In other words, move somewhere else where you will be treated better. You can retain your wealth. And too many people suffer from too much inertia. They're going to hear this and say, but kids, but that, but schools. Make your excuses if you will. They're coming for you. They're coming for your wealth. They will flatten you, and you will be ward of state, and then everyone will be on welfare, and you will comply or you will cease. And you can go look at the images of Chinese citizens that have lost their status to engage in the economy, that are sleeping like beggars on benches. You shall comply. You will be given no other choices. That doesn't sound very attractive to me. I would find schooling for my children and leave.
Francis Hunt, this chat has been incredibly thought-provoking. I would love for you to talk about the market sniper for a second.
Yeah, if you want to engage and you see the world as we see, this is actually an opportunity. It sounds doomer. I don't come here to show up to miserable people out, but I'm going to tell you the truth as hard as I see it, and everything we predicted keeps unrolling exactly like we predicted it would. We're not the only ones. Other people have made them. We just put our case forward. We recognize where the economic model is in existence, how it's going, and where it ends up. It's all in the trends. It's all in the direction. I don't think it's so extreme as it might sound, but you just have to take the time to think it through. There is real opportunity by not being captured in a massive downdraft to your wealth. And in fact, you can play this out to enhance your wealth. So with every crisis, opportunity, as per the Chinese symbol, as I described, you either recognize this and position for the opportunity and are riding the wave, or you're one of the people getting dumped by the wave. I've made my choice, and I specialize in helping community members benefit, build wealth through positioning for the reset, preserve that wealth through existing and defensive mechanisms, multiple jurisdictions, and secure a life of greater freedom and access. And believe you me, I'd rather be a wealthy slave in a global system than a trapped one in the West under complete draconian rule. If you see it like that, join us at the Market Sniper YouTube channel, where you can follow my unique technical analysis utilizing the HVF method, which sees low volatility to high volatility expansions. We have unbelievable rainmaker trades going on right now that are all deeply in profit and are all part and parcel of this grander reset which we see coming. Also on X, under the same name, the Market Sniper, we covered crypto as well, the Crypto Sniper on YouTube and X. Thank you for having me on, Stijn. Delighted to have been with you.
Thank you so incredibly much, Francis, for your time and your insights today.
My pleasure.
This podcast is for general information purposes only and does not constitute investment advice, an offer, or solicitation to buy or sell any securities. The views expressed are those of the host and guest and do not necessarily reflect the views of the company or their affiliates. Guests on the show are not compensated for their appearance. Certain discussions may include forward-looking statements subject to known and unknown risks and uncertainties that could cause actual results to differ materially. Listeners should do their own research, consult a licensed financial advisor, and not base any investment decisions solely on the information discussed. For a full disclaimer, please visit our website, and for full disclosure and risk factors of any companies referenced, please see full available disclosure and risk factors on their CEDAR Plus at www.cedarplus.ca.